Hey, what's going on, everyone? This is Sawcruhteez Streamz, and I am your host, Sawcruhteez. Today, I'm very excited to be bringing you the final episode of the BitMEX tutorial series. This will be BitMEX 105, BitMEX tutorial 105, and today we will be covering the futures, hedging, arbitrage, and the basis. And this is a more advanced, these are more advanced concepts that aren't needed to trade on BitMEX. If you understood everything in the first four episodes of the BitMEX tutorial series, then you know what you need to go ahead and dive in and make some trades. And beyond that, it is important to understand some of these concepts, and these concepts aren't exclusive to BitMEX by any means, but I do think that this is the best place to cover them because the BitMEX futures are the most liquid futures and the most popular. I really don't even know who else out there offers futures for Bitcoin. I'm sure they're available, but me personally, I haven't taken the time to really find any alternatives because I've been so happy with BitMEX myself, not only for the perpetual swap, but also for the futures contracts. So that is what we are going to be looking at today are those futures contracts and how they can be used to hedge, how you can arbitrage with them, a trading strategy that is based around the basis, and also how you can use that to potentially identify major tops and major bottoms in long-term bull or bear markets. So there will be a lot to get into today that even if you don't think you're going to implement some of these things into your trading strategy, I still would recommend understanding them just so that you know if there is opportunity out there, that you know why you're passing up on it, and you understand what the purpose is for the futures, and also just how to analyze the futures curve. So with all of that being said, I will go ahead and jump right into screen share. And we are going to start with this guy right here. So for people that are new to futures and the futures curve, this is a great resource that is out there for free through the Khan Academy. This is what I went through to learn, to teach myself about futures and to learn contango and backwardation and that sort of stuff. And it's a really, really well put together, very comprehensive, and definitely a great resource for anyone. I mean, it starts from the very beginning. If you don't know what a futures contract even is, then you're going to get an introduction. They're going to, go over motivation, like why futures exist, and margin mechanics, hedge with futures margin mechanics, futures and forward curves. So that is what we're kind of looking at right here on this screen, is what is backwardation, and what is important for you to know today, just in a nutshell, is that a normalized futures curve, it occurs when the future is more expensive than the spot. And that occurs generally because of the carrying cost. It costs money to store commodities, and therefore, if you are wanting to buy it now versus buy it in the future, it is almost always going to be more expensive in the future to account for the carrying cost. And when the futures curve is normalized, it is considered in contango. And when it is not, when the future is cheaper than the spot, that is backwardation. And there are some important things that we can glean from when the market is in backwardation, and also when it is in extreme contango. So we're just going to very quickly pull up the BitMEX platform to see what the futures curve may look like right now. We see, if we're on the Bitcoin tab, we have three options: perpetual, September 27, December 27. And the further that you go out on the futures curve, the more expensive it should be, the longer you're having to account for carrying costs. And that's where Bitcoin is definitely different than traditional commodities and traditional markets in terms of it costs very little to store Bitcoin. So the premium is mostly built in due to speculation, as far as I understand it. The premium that we're seeing here isn't necessarily accounting for carrying costs, because carrying costs for Bitcoin is almost free. I mean, you buy a ledger one time and you store it. So if you're storing for 3 months or 6 months or 12 months, the carrying cost is basically the same in Bitcoin. Whereas the futures will still increase in price the further you go out when the market is in contango. And the more extreme that spread is, the more the market is over exuberant. If the future is getting, say it's normally about 3% greater than the perpetual, and all of a sudden it gets up to like 5 or 6% greater, that's a big indication that the market is getting very over enthusiastic and overconfident that the price will be much greater than that before this expires. And on the other side of the token, what if these all of a sudden become cheaper than the perpetual? If September's contract was like 10,600 and December was 10,500, well, what would that tell us? On the flip side of the token, it would tell us that the market is overly bearish, and that they are not even, they're afraid of holding on to contracts that are a little ways away from expiring, because of how much they are afraid that the market could move down at that time. So something to note is that the futures curve can be used to identify major tops and major bottoms in long-term bull or bear markets. In Bitcoin, a long-term bull market could even be just, like 6 months or so. But it's important to understand that it's not a week-to-week sort of indicator. It's something that is for longer-term moves. So if you have a major sell-off that occurs and then you get the market in backwardation, well, that is a very strong indicator that people are panic selling. And if you get a big run up and all of a sudden the spread between the future price and the spot, I always use the furthest expiration and the spot, if all of a sudden that gets exacerbated, well, that tells us that people are FOMO buying at or near the top. And it is very important to understand that the basis is not a timing indicator. I have learned a large majority of this from Ugly Old Goat, so we might as well just kind of go over there right now. This is another resource that I will be sharing. I learned this approach from Ugly Old Goat, and I have been extremely impressed by the way that he has used it to trade the markets in real time. And he has shared many positions over the last year or so on Medium. And I want you guys to go ahead and go out there. If you are interested in learning more about the futures curve and about basis, then this is where to go. Ugly Old Goat's Medium page, if you come on the most recent stuff, isn't as... it used to be much more focused on it. Now he's kind of branched out and done a little more. So titles, you can kind of just scroll through, look for contango, backwardation, basis, anything along those lines. Will be articles covering that. And what I have done, what worked really well for me was just going to Google and Googling Ugly Old Goat and the basis. I'm not sure why that'll change anything, but here it will give you a bunch of articles, so you don't really have to scroll through and see. Study of a bad trade, great article. Basis says the bottom is in Bitcoin, another great article. So definitely go through and read Ugly Old Goat's post about this topic, and also go through the Khan Academy post, and that should get you up to speed for how backwardation can be used. And one thing he stresses is that it's not a timing indicator. If you enter backwardation, it could stay in backwardation for a very long time. And in fact, I have seen that. So you need to combine this with a timing indicator. If you see that the market is in backwardation, then it tells you to be bullish, but it does not tell you how to time an entry. So that's where you need to use another indicator to help you time an entry, such as a moving average crossover or a TD sequential, 2 above a 1, something along those lines. You need to have a timing indicator combined with an understanding of basis to use it to enter trades. So that is a quick overview of what the futures curve is and also how it can be used to potentially identify major tops and major bottoms. So what we see is that right now there's about a $200 spread from the spot to the future, very normal, and that's something that you kind of have to follow on a regular basis. I've tracked this daily for maybe a year now just to get a feel for what is extreme contango, and my rule of thumb is about 3.5%. If we're about 3.5%, that's pretty darn normalized. If it gets more than that, start watching out. And I want to go over a few quick examples of where we have seen extreme backwardation and extreme contango. So we're going to pull up the charts, remove all the indicators. And what we are looking at is the Bitcoin chart. And I want to just kind of point out where I remember there being backwardation, and this is something that you can potentially confirm for yourself, either through Ugly Old Goat's articles, going back and looking at data. I don't know. I'm sure there's a way to go back and confirm. So I'm just going off of memory here, and I've been following this for a while. I've got a pretty good memory of what was going on. So I just want to point out that, first of all, we entered extreme contango right in here when we were running up through 12,000 or so, maybe 11,000. Right in here, we did enter extreme contango, where the futures became, I want to say, 5% or more, have a 5% premium or more from the spot. And right here, we did have a post from Ugly Old Goat where he said, watch out, this is very, very bad. This market is in a very bearish structure with that extreme contango. We are getting a strong sign of a local top due to that extreme premium in the future, indicating that people are basically FOMOing in at the top, not caring about how much of a premium they're paying for a future contract because they believe so much that the price is going to continue going up, that any premium, $400 around here, just $500 or so, just isn't something that they were necessarily worried about. Ugly Old Goat caught that and said, watch out, this could be a local top, and now he is the futures curve returned to normalize back in this area. So as far as I understand, he believes that the market is no longer in that dangerous structure of extreme contango. So it can go extreme and then correct itself without much of a correction in price. And that could definitely be what we saw here. So again, it's something that when there was extreme contango, it was going to be very, very hard for the market to continue upwards because of how much people were going to be arbitraging that by selling the future and buying spot, or just selling the future if they were feeling very aggressive. So we will get into that here very quickly about how arbitrageurs would have been taking advantage of this situation and how that would have made it very hard for the market to continue upward before that that discrepancy was arbitraged out, basically, until that roughly 5% premium was brought down to maybe a 3.5% premium, and those arbitrageurs, made their money and would no longer be providing significant selling pressure to the future contract. So just back in here, we did have backwardation down here at the bottom. Ugly Old Goat was talking about how the basis says that the bottom is in. Down here, there wasn't a it stayed in backwardation for a long time. Like I said, that can happen. I think it entered backwardation in here. I remember that being the strongest indicator that this market wasn't going down. Everything made it look like this market was going down right here, in my opinion, except for backwardation. And that's something I talked about regularly on my TradingView posts, that this backwardation is sure concerning for anybody who is short or bearish down in here. That backwardation was persistent as we kind of consolidated. It was there for a long time. So if you were right here saying, oh man, backwardation, I buy, well, it went against you for a while, and you had to understand that maybe you needed a better timing indicator, or that you just have to be okay holding on as long as the market stayed in backwardation. Even though the price had moved against you, it was still in the same posture to go ahead and move up. The other interesting thing, when I really started paying attention to this indicator, is when Ugly Old Goat started talking about the bottom being in when we were testing 6,000 down in here. He made multiple posts like around in here saying basis says the bottom is in, basis says the bottom is in, basis says the bottom is in. If you go back, let's just go to, right, basis says the bottom is in May 8th, 2018. So we go May. Okay, so I was definitely wrong there. I'm glad we double checked. So he was looking, even up here, we still had backwardation, which was amazing. And it was persistent. The backwardation was happening when the price was down in here, and it just stayed as the price continued to rally. And it stayed. We stayed in backwardation for a very long time. For a very long time, it was cheaper to buy future than to buy the spot. So all throughout here, Ugly Old Goat was saying that the bottom is in, and what really, really, really impressed the hell out of me was that he was, it seemed like, consistently buying 6,000 support. You're going to have to go back and read the articles yourself. This is a while ago. From my memory, I remember him being bullish when we kept coming down and testing this $6,000 support. Every time we got a bounce, he was bullish. And then all of a sudden, like right in here, he turned bearish. Everybody was turning bullish right in here. It was, in my opinion, a pretty weak fake out. I wasn't scared at all and had multiple posts saying such, but a lot of people were looking at, holy crap, we just broke this trend line, and now it is time. We just built this nice bottom. We broke the trend line. A lot of people were very, very convinced that the bottom was in right here. And Ugly Old Goat took the exact opposite stance. As far as I remember, he made money buying 6,000, and then he made a lot of money shorting it when it was ready to break down. So every time it held a support, he bought, and then when it broke down, he sold. And I remember that pretty vividly. I don't remember where he was getting out. I just remember where he was buying. So that's something that, again, doesn't really indicate an exit. This is just something that helps to indicate major bottoms. And here it looked like this could be a major bottom, and for sure for a long time it was. You had a very long time from February to November. What's that, 9 months or so, 10 months, 9 months, where this was a very strong case to be made that this was the bottom. And as we were in backwardation, as price tested support, it was very hard for the price to go lower as long as we remained in backwardation. From the flip side of the token, there's going to be a lot of people buying those futures, a lot of buying pressure coming in where you can buy low and sell high on the spot. So we will get into that momentarily. Just wanted to point out, as you go through Ugly's articles, note when he is saying the bottom is in, and even if he was wrong like 4 times, that was irrelevant to me, because he bought support as long as it held his support, and then as soon as it broke down, he went ahead and shorted, because now we were pulling back to support in contango. So he said, look out. As long as we were in backwardation, he was expecting a bounce. When we came back to test support in contango, it was a strong indicator to him that support was going to break down. Okay, so, and that was just really, this is where I really started to believe in it, because I had a hell of a time right in here. I was very bearish and absolutely expecting support to sell down, break down off of this descending triangle, but it just took forever for it to happen. From, I remember, September to November, I had a hell of a time just getting chopped around. I did excellent back in here. I did a good job myself, kind of buying support and then also shorting at resistance, doing that all publicly. And then in here, I was really wanting to bet big on a short. I was very confident that we were going down, and man, it just was really tricky, like coming down, bouncing up, coming down, bouncing up. All this was very tough, and Ugly didn't, he just timed it perfectly with watching that contango and that backwardation move back into contango, and potentially his timing indicator was taking out these lows, something around those lines. I know that he follows very closely, taking out 2-week lows and 2-week highs. So I will go ahead and shill his newsletter. I am a huge fan of Ugly Old Goat. I believe he's one of the best traders in crypto, specifically one of the best that does it publicly and teaches his techniques. He has been on the BitMEX leaderboard before. Anybody that makes it on the BitMEX leaderboard has made an absurd amount of money, and is somebody who I have a lot of respect for. Anybody that knows how to trade that well, there's something that they can teach me. So I have been following Ugly Old Goat for a very long time, at least since he has been really making trades public and going through his strategy on Medium, and I am a big supporter of his. I absolutely recommend to subscribe to his newsletter. He now makes his positions and trades available in real time, and he does a really good job of explaining his approach, whereas he was maybe a little bit more vague in Medium. It's only a one-time fee. It is absolutely worth it, and I do have an affiliate link below, so if you are interested, please use the affiliate link to go ahead and sign up. That would be awesome. So now what we are going to look at, we just looked at how this could have been used to trade throughout a very difficult environment. It did a very good job of providing buy signals when the market was ready to move up, and then it also did a very good job of telling you when the market was in a position to break down. So now let's look at potential ways that the arbitrageurs would be taking advantage of extreme contango or backwardation. Okay, so I guess the best way to do that, I believe, will be to pull up a chart on TradingView. So what I'm going to do here is just turn my price chart into a line chart. We've got XBT, USD, BitMEX as the ticker, and what we're going to do is use December future to compare XBT Z19. So we click compare XBT Z19. Okay, and we will go ahead and zoom in so that the scales are close. Let's see what we can do here. When you add a chart, it adds a new scale to the y-axis, so it can make it kind of tricky to make sure that you are looking at the right zoom, and potentially this is not going to be exactly accurate, but I will be able to just kind of show what it is that I am trying to illustrate. And this definitely isn't accurate because it shows the future as almost always being cheaper, even though that has not been the case. So yeah, it's just tough on TradingView with these different scales to get that zoomed into the right spot. And now this looks good. At least it's going to let me, and see, what I look for is just try to get these accesses lined up. 10,006, that's getting close to this 10,006 over here. So basically, this will show you how it is possible to arbitrage the futures. You look for this spread to get exacerbated, and then you bet on it to come back to parity or very close to it. I think par is what you would call it, come back to par in these markets. Okay, so what we see is that right in here, we have the spot down in here, and the future slightly above. So let me go ahead and just make that a little bit bigger. Can we do that? Okay, so we see we've got the spot down here, future up here, where there's, you know, a spread. Back here we do have the spot above, but there's really not much of a spread. They're, you know, pretty darn close. Once they start to spread out, now we have some arbitraging opportunities. So what you could do is buy spot, let's say right here, buy spot for 98.68.5, sell future for 10,075. This future is over here on the left. That's why it's 10,075. Okay, is the future, and the spot is 98.71. So let us determine how big of a spread that is. And this is where the percentages aren't going to be exactly accurate. I mentioned 3% being the kind of 3.5 being a good spread, and above that to be something to watch for. So because of this funky scales on the TradingView chart, this percentage isn't really going to relate to probably what it was in real time, but this is just the best way that I know to illustrate what I'm showing you. And I literally have just tracked this pen and paper by day to, and I'm sure that there's a better way to do it, but that's something that I really like to do, is to follow indicators by hand with pen and paper. That really helps me to get my finger on the pulse of what's going on, opposed to a little bit better than just looking at a chart. So this is probably not going to be what the spread was, and a 0.98 spread between spot and future is not significant. So I apologize that this is kind of confusing, but I'm just trying to illustrate a point, and that's what's important, is that when there's like a normalized, you're normally got a small spread, and then all of a sudden you get this gap. And when you get that, it is an arbitrage opportunity. So basically what we were looking at there is that this is, in this situation, this example, we're looking at, let's call it 1% spread between the spot and the future. So what you would do is you would bet on that to come back to around par. And that is where you would get out. So you would buy spot, sell future. And if you are expecting the curve to, the spread to decrease, then you would likely want to bet a little bit more on, just have a little bit more exposed on the sell. So if you're selling the future and buying spot and expecting these to come back together, then you would be wanting to adjust your bet sizes accordingly. And that's something that I really don't have much experience in at all. So you will have to, that's why I had that down there. You will have to think about this a lot yourself and experiment a lot yourself before putting any significant money to play. But the idea is if you can sell up here and buy down here, then as the market moves in any direction, you should be breaking even in terms of if you, let's just use easy numbers, if you sell 1 Bitcoin on this guy and 1 Bitcoin and you buy 1 Bitcoin here, well, the amount that this goes down is going to be greater than the amount that this goes down. So as it's going down, your account is increasing in value. Even though this is losing value, you went long here and it went against you, and so you're losing, but that's being made up for by this gaining value. So hopefully I can make this very clear and just show that what happened when we entered. If we entered here, our long went down 4%, and our short went down 4.86%. So there you go. There you have it. That would be how you would have capitalized on maybe 0.7% or so. And that's the thing about arbitraging in general, is that it is not going to be, it's generally best suited for bigger bankrolls. You're only going to be going for very small percentages of very, very low risk, high probability trades that only provide small percentages. Somebody with $1 million who can take a very low risk trade to earn 1%, that can be pretty darn significant, versus somebody who maybe only has $10,000 and you know, 1% just maybe isn't going to be that big of a deal to them. So hopefully I described that well, even though it's something that I'm sure there are other people out there who could describe it much better. I am doing my best to provide you with the basics, the fundamentals, and then if it's something you want to explore more, absolutely go and learn it for yourself. So let's just do math really quickly to help illustrate this fact a little better. Or not fact, or just illustrate this trade, I guess, this practice trade. So we buy 1 BTC at 98.68. Sell 1 BTC at 10,072. Remember, we're looking at this axis, so 10,072. The long loses let's call it 4.12. Short gains 4.89. Okay. And the long loses 0.0412 BTC. Short gains 0.0489 BTC. Difference is, can't do that in my head, so quick calculator, 489 minus 412, 0.0077 BTC. And a lot of people might be wondering about, that's probably going to just be a wash after the fees. Not necessarily the case with BitMEX, because they pay takers. Taker fee, and I'm wanting to make sure that my memory is correct, so hopefully this won't take too long. I think it's 0.02% BitMEX taker fee. Screwed that up. Maker fee. The maker is the one that gets paid. The taker is the one who does the paying. So yep, 0.025%. So let's see here, back to our chart. Maker fee, 0.025%. So basically, if we were disciplined and diligent, we entered both of our positions and exited both of our positions with limit orders, then that's actually going to add to our gains. So we would get a maker fee 4 times. Basically, maker fee for the buy Bitcoin. So let's do 0.0. Since it's 0.025%, that is 0.00025 times 1. So we would be looking at 0.12325 BTC plus 0.00025 BTC per limit order. There was a limit order to buy, limit order to sell, limit order to exit both of those positions. So 4 times we would have been had the chance to enter a limit order. So we can times that by 4, and we've got plus 0.001 BTC. If we used limit orders, and depending on the funding rates, if the funding rates were negative or positive, we might have to pay there. In my experience, that should basically be about a wash and maybe even to our advantage. But we're just going to say that this is what we're looking at here. So grand total would be, total P&L is 0.001 plus 0.0077 gives us plus 0.0087 BTC. So 0.0087 divided by, we'll say 2 Bitcoin, because we did expose 2, one to the upside and one to the downside. In reality, I would kind of just consider this a 1 Bitcoin exposure when calculating my ROI, but let's just say both of them, and that would give us a ROI of 0.435%. And again, that may not seem very exciting to a lot of people, but if you can repeatably do it, then it can potentially be a very low risk way to make some money. And the way to maybe add a little bit to that, if you get a little bit more experienced and you are gaining a lot of confidence with this, then you can start adjusting bet sizing. And that was something I brought up earlier that probably made it confusing, and that's why I wanted to go through all this to hopefully clarify that a little bit, in terms of, you see that our shorts gains beat our longs losses. So if we did a little bit bigger position on our short, that would increase our gains, right? If we did 1.5 Bitcoin as the sell, then our gains would be 1.5 times 0.0489, 0.07335. That would increase the gain significantly, also increases the risk significantly. So that's something that I am not going to share. I don't know the best way to set up the bet sizes based on how big the spread is, but that's what the expert arbitrageurs absolutely know exactly what they're doing. And hopefully that illustrates how it is difficult for a market to move up when there is a significant amount of spread between the futures, specifically in contango, because there's going to be people coming in and selling the future more than they're buying the spot. Even if they're arbitraging in this way, there's going to be more sell pressure for this than there will be buy pressure for this, and that can be enough to absolutely cause this market to turn around. We do see that right in here, there was that spread, and the market did go up. But the market didn't go up until the spread decreased. So as long as this spread was significant, it was going to be hard for the market to go up. If there was maybe just a lot of outside demand from, that overwhelmed the arbitrageurs, or anything could really happen. But just to realize that in this situation, if we did the same exact amount of sell here and buy here, we're going to be making money as the market goes up, because as these curves get closer, if we sold the same amount here and here, that's why this is the most conservative way to do it, because that's direction neutral. If you're one Bitcoin short here and one Bitcoin long here, and it goes down, you expect the short to make more than the long. If it goes up, you expect the long to make more than the short. As these curves get closer together, now the short will be down slightly less than the long is up. And if the spread was 1% here and it moves to 0.25% here, well, you're up 0.75%, regardless of direction. And that is something that, why you need to be very careful of increasing exposure to one side, because if you do bet more, say here on the short, than you did on the long, now you're going to be losing money as the price goes against you. But if you bet the same, then as it goes up, the long will get more gains than the short loses. And the difference is what you will net. And that is how to arbitrage the futures. Okay, so now we are going on to hedging. We have basically made it all of the way through everything that is important. So I'm definitely glad that we had the chance to go through the math on all of that, and definitely something to take a look at for yourself. Something else to consider is that as the future gets closer to expiration, the closer the spread will get. So as we talked about before, the further out the future is expired, the more you expect the premium to be. If we've got a spot versus a contract that's expiring 6 months down the road, that should be much more expensive, the 6-month expiring future, and I'm just using random numbers, than a future that's expiring 3 months down the road. Because in general, the carrying cost, the longer that you have to carry the commodity, the more expensive it is. So as a general rule of thumb, the farther that you go out in the expiration date, the wider the spread should be in the premium. If you've got an expiration that's a year out, then it has to count for a year of carrying charges. And even though Bitcoin doesn't cost much to carry, that's still how these future markets operate. If you're only going out a month, well, you only have to count for a month of carrying costs. So therefore, you would expect it to be maybe like a 1/12 of the premium. Right? If there was a $1,200 premium on a 1-year expiration, then a $100 premium on a month-long expiration is what makes a lot of sense. And that's an area where there are people who make a ton of money arbitraging traditional markets when there's any sort of spread in there. And they'll literally buy beans and figure out where to store them if they realize that they can store them for cheaper than the carrying cost that is priced in. That's a huge business, absolutely. And we want to consider, if that's the case, well, what happens as the future gets very, very close to expiring? What if right here, the contract is for December 27th. Well, what if the date on that is, what if now we're at December 26th and it's only 1 day until this future expires? What happens then? Well, you would expect the premium to decay down to almost nothing, right? So that's something to keep in mind if you are going to be using this approach to try to arbitrage the futures and take advantage of the basis. Then you need to be very aware of when the contracts are expiring. And as a very basic approach, when the futures open, you can go ahead and enter a positioning yourself that you are expecting the spread to decrease as you get closer to expiration. So if the future just opens and we've got a spread, we can go ahead and position ourselves and know that, man, once this gets very close to expiration, we have very, very good reason to believe that these two will come back to par or very darn close to it. Because if there's only 1 day until expiration, what's the carrying cost on 1 day? It's basically nothing, right? For any commodity, you know, even if it's something that is hard to store, if you've only got 1 day to store it, that premium should basically disappear. That is what is expected to happen. So that is a sort of basic foundation that you can use, is that as futures open and become available, that's when you expect the spread to be the widest, regardless of market participants being afraid or having fear of missing out, regardless of anything along those lines. Once the future opens, it's the farthest date until the expiration, and therefore it should be the widest spread in the futures curve. Not always the case, but it is a good foundation if you are looking to implement this approach. If you come in knowing that the premium will decay as time goes on, and you can position yourself to take advantage of that by selling the future and buying the spot in contango, and the opposite in backwardation. So we have gone over hedging, arbitrage, and using the basis to potentially recognize major tops and major bottoms. And now just want to talk very quickly about why futures exist. And futures exist for the producer of the commodity to hedge their risk. If somebody, let's just use apples for example. If you have an apple farmer, and this apple farmer is, you know, producing however many bushels of apples, there's a certain price where he's at break even. And if it falls below that price, if the market price of apples fall below his break even price, let's just say 10 cents an apple, whatever you want to call it, if the market price falls below that, then this farmer is in great danger of losing his ass. I mean, think about the long history of how important farming is, and how often the market fluctuations can put a farmer out of business. And that is a big risk for a modern society. We need to make sure that our farmers, at least the savvy ones, have an ability to offload their risk to speculators such as myself and probably everybody else watching this video. So if they see that the futures contracts for their apples are at a price that can allow them to lock in profit for this year, then they're almost dumb not to do it. It just makes so much sense. It's very much like insurance for commodity producers. They're essentially taking out insurance that if something were to happen, I'm still going to be in business. You know, and on the flip side, you know, maybe there is a hurricane that wipes out all of the apple orchards and wherever apples are produced, and now his apples that he has became way more valuable. Well, now he has cost himself that, but farmers aren't in the business of speculation. They're not wanting to speculate on what's going to happen on the price of apples over the next, you know, 6 months or year or whatever. They want to know that if I produce X amount of apples for X price, I can sell them for X price plus, you know, 20% or whatever the case may be. And as long as I can do that, I'm in business. I'm feeding my family, I'm paying my employees, and the family farm is not going to have to be, you know, sold off to the bank or whatever the case may be. That's why futures exist. And the people who pay for that, basically the producers of the commodity are the ones who are offloading risk. And the people who assume that risk are individuals who speculate in the futures markets. We know that the large majority of speculators do not make money consistently. In fact, the large majority lose significantly. And that money that they are losing and that risk that they are assuming, they are taking off the hands of the farmer who does not want to speculate. And that is the beauty of the futures market, as I understand it, is it allows the farmer to just be an apple farmer, and it also allows a speculator to speculate. I mean, there's nothing wrong with people that like to speculate, whether it be on a casino game or a futures market. You know, if you're of your own accordance, of your free will. You're wanting to risk your own free money and time and emotional commitment to speculate in these markets where experts are using these markets to make a living, then that's up to you. That's totally fine. And that's the beauty of the free market, is that we can bring these two parties together, one that doesn't want risk and the other one that does, and exchange that through proper use of futures, at least from the commodity producer standpoint. So now let's take a look at Bitcoin and the ability for miners to hedge against the cost of Bitcoin. In the 2018 bear market, everybody was talking about how maybe afraid they were that the price of Bitcoin is going to get below the average cost of mining a Bitcoin. If that were to happen and miners are operating at a net loss, that could potentially be a serious issue for the network, in terms of miners have to feed their family too and keep the lights on. And if they're every Bitcoin they mine, they're losing $1,000 instead of making $1,000 or more. Well, that's something that maybe can last for a little bit, but certainly cannot last for too long. And that is where the savvy miners will protect themselves with futures. In 2017, the price was going, so far through the roof that it was well above the cost of mining a Bitcoin. Therefore, the savvy miners were able to hedge their exposure to the future price dropping below their cost of producing by selling futures. And just think about in Bitcoin. Let me get this out of here. And I am wrapping this up here very soon, but just a couple last things to mention here very quickly. So think about when Bitcoin was up in here. We were, everybody was FOMOing. We were at the top, and what did we get? We got extreme contango, where the premium of the futures was like 10%. Like, it was the most extreme contango that maybe we've had, and I don't know to say that for sure, but the most extreme that I can remember, where we expect it to be 3.5% or so. If it gets to 5%, that's a great arbitrage opportunity. If it gets up to 10%, alarm bells are ringing that holy crap, something is really seriously wrong here, at least from the sustainability of this move. So miners that depend on high prices of Bitcoin, the savvy ones, were coming in here and selling these futures for $22,000, 10% above where this price got to, all the way, as that was occurring, from 15,000 all the way up to 22,000 or so. Miners had the ability to lock in their profits for the entire next year, at least the next 6 months, and you could make so much profit in that next 6 months that it would make your entire year. So here, miners had the ability to sell contracts for Bitcoin that didn't expire for another 6 months and were at a significant premium over the spot. So as the price was all the way coming down in here, they were able to mine Bitcoin in June and then effectively sell it for $15,000 or $20,000 due to that future that they sold back in here. And that is just one more thing that we will take a look at, and that is back to Ugly Old Goat's Medium, and he did post an article right around here. The contango is a godsend for miners and a curse for speculators. So right here, as we were re-entering extreme contango and rallying through 11,000, the contango went, it was between $400 and $800 difference between the future and the spot, which Ugly Old Goat recognized as a godsend for miners and a curse for speculators. And he said that basically any of the savvy miners that know how to deal in futures were able to lock in their profits for the remainder of the year. Here's a quote from it directly. Not only did miners benefit from a substantial price rise, but during the recent rapid hyperbolic rise, these Bitcoin producers could and did lock in prices for the next 6 months at a premium of $400 to $800 over the spot market at prices ranging from $11,500 to $14,500, guaranteeing very profitable mining operations for the remainder of 2019. What happens if Bitcoin goes below 3,000 in the next few months? Very, very, very unlikely. But what happens if that were to occur is that the miners that hedged in here are not going to worry at all about losing money on the Bitcoin they mine, because they will effectively be able to exchange that for very, very, very profitable rates. And that is what savvy producers of commodities do, because they really shouldn't be in the business of speculation. If you've got a profitable mining operation that's netting you millions of dollars a year, your main concern is protecting yourself against the volatility of Bitcoin. Your main concern isn't, your $1 million operation turning into a $10 million operation because Bitcoin goes to 100,000. You're hoping that potentially that does happen down the road, but your main concern is staying in business and keeping the lights on. And in this extremely volatile market, if you are a miner who has, the large majority of your income exposed to mining Bitcoin, and you are not hedging when extreme contango occurs, then you're really doing yourself a disservice, and you're going to make it very, very difficult to succeed in the long run. So that is starting to get a little bit beyond the scope of this video series. I wanted to make sure to do my best job to provide you all with an introduction to the different reasons why futures exist, how they are used properly to decrease risk by miners and producers of commodities, how they can also be used to take on direction neutral trades that would be arbitraging the spread. When the spread gets exacerbated, you can arbitrage and capitalize on that when the spread gets back to normal, regardless of what the price of the underlying asset happens. If you are exposing the same amount on both sides of the trade, if you get really good at trading that, you can potentially start adjusting bet sizing a little bit to increase the returns. And we also looked at using the basis to potentially recognize major tops and major bottoms. Extreme contango is a situation where it is very hard for the market to sustain that rally. That is a very good indicator that the market needs to correct itself and is in danger of a full-on reversal. And the backwardation can be a great way to identify when the market is going to have a very hard time moving further down. If there is backwardation and price is at support, then you can be pretty confident that support should hold and any breakdown would be just a fake out. If you're not even at support and there's backwardation, well, you can have some level of confidence that the market's going to have a very hard time moving down further from here until that spread is brought somewhat back to normal. Specifically, if it's in backwardation, you would be looking for it to return to being normalized before the market would be ready to continue moving down further. Like we saw at 6,000, when it was in backwardation, 6,000 held. As soon as it returned to contango and tested 6,000, that fell apart and moved down in a big way. So that's definitely a good thing to be paying attention to, even if you're not going to be using futures to hedge or to arbitrage. It is a very important indicator to understand as far as I'm concerned. Ugly Old Goat has made some recent posts saying that he does think that the market is maturing and that we will no longer get these opportunities with backwardation, as specifically prolonged backwardation. He thinks that we are going to become a more mature market and experience that situation much less like the traditional markets do, and he knows way more about this than I do. I just kind of wonder, since there is so little carrying cost with Bitcoin, could potentially the backwardation be more persistent than it would be in other markets. So I have left some links below for Ugly Old Goat's Medium. Also for the Khan Academy, go through both of those if you're wanting to learn more. They are great resources. And then I have also started to affiliate for Ugly Old Goat's newsletter. Like I said, have a lot of respect for him. I wouldn't be suggesting anybody who I haven't followed for a long time and have a lot of confidence in their abilities based on what I've seen in real time. So I definitely am more than happy to be an affiliate for him. Definitely give that a look. It's a one-time fee, and you're getting access to this guy's positions in real time and his orders in real time before they get filled. And this is somebody who's been on the BitMEX leaderboard. He's one of the best traders in crypto that I know of. So can't speak highly enough about him. And he is that's where I've learned everything that I went through today, and I really apologize if I got any of it wrong. I've done my absolute best to gain a grasp of these concepts, and I do feel comfortable with them, but I'm sure there are some very, maybe some intricacies that if Ugly was watching, he would maybe have some disagreements, and if that is the case, I definitely would divert to his expertise. I'm just doing my best today to give you a foundation, give you an introduction to these higher level concepts, and then also some resources to go ahead and learn more if that's what you want to do. So thank you very much, everyone, for tuning into the BitMEX tutorial series. Of course, I am affiliating for BitMEX as well. If you have found these series helpful and decide that you do want to sign up and go ahead and get registered on that exchange, go ahead and use my affiliate link. That will support this channel. It will also get you a discount in fees, basically a win-win situation. And again, thank you very much for tuning in. This has been Sawcruhteez Streamz with the BitMEX tutorial series.